Real estate is in a category 5 hurricane, says Barry Sternlicht. This is a really interesting quote that came out from one of the most prominent voices in real estate. Barry, of course, is the co-founder, chairman, and CEO of Starwood Capital, and spoke recently with Bloomberg Wealth to the fact that real estate has had a really tough time acclimating to the high interest rate environment. We'll get into that relationship in just a second, but I do want to highlight the quote here, category 5 hurricane over real estate. And you can see exactly what he's speaking to, not news for real estate investors, as the ETF here, XLRE, down 27% from the start of 2022, and one of the few stock sectors that's down on the year here. I mean, you're looking at technology and these other sectors of our economy bouncing back 10%, 20%, and real estate's still having a hard time figuring out this new environment, as they're even lower than pre-pandemic prices here are real estate stocks. And of course, this is a little bit of a different story here, looking at the wider lens of XLRE that was able to put in, higher highs throughout 2021, but then peak at the end of 21, start of 22. And I want to break down what's changed since then. Why do we see this peak, and what is Barry talking about when he says, there's this hurricane that's looming over real estate? It's actually pretty practical what has changed in this market. And just to put a bow on this peak and what we've been seeing in prices, even the average price of houses sold in the U.S. From the St. Louis Fed here has peaked around the same time. Now, that being said, at very least, you are seeing gains, net gains in the price of actual real estate, not the real estate stock markets that we were just looking at, since the pre-pandemic days, substantial gains. But we're far past the peak now and edging lower every quarter here for about the last year. And yeah, this begs the question of what has changed. What is this hurricane that's looming over the real estate market? And it's actually pretty direct. You see here the relationship between U.S. interest rates and the real estate market. And that's the biggest difference since real estate peaked in 2022. And two, almost a mirror image here as interest rates have climbed higher. Real estate stocks and the price of real estate, houses and everything else in the U.S. Moving lower. And you can see in this time from the end of 2021, where we were in a 0% interest rate environment, until now in a 5% plus interest rate environment, the correlation to the inverse, the downside for real estate in that same time, like we just pointed out, real estate stocks losing more than a quarter of their value. And so, what is going on here? What are the actual ins and outs, the inner workings of this hurricane that's looming over the market? And how can it dissipate? What can pick this market back up? Well, first, let's talk about the effects of this high interest rate environment that we're spoken to in the interview. It's a great piece to go take a look at. But you see the sensitivity of real estate to interest rates for a number of reasons. I mean, on the end consumer level, you have more expensive mortgages. That's going to be the most obvious piece that most everyday people understand. A lot of the people who obviously refinanced their mortgages or took out a mortgage during the 0% interest rate times of, around the pandemic there, interest rates went down to 0%. And then a few years before the pandemic, interest rates were at 0%. Then they're feeling pretty good. And now people having to take out mortgages amid the hot real estate market of the last couple of years that, like I said, has peaked and is starting to fall off a little bit, saying to themselves, wow, man, I have to finance this real estate purchase no longer at near 0%, but 6%, 7%, 8%, depending on all the factors that go into a mortgage there. And that's going to really decrease demand. It's going to decrease demand, and it's going to decrease the prices, like we just saw, of the average home sales here in the U.S. And also outside of that consumer level, at the corporate level, the stocks that we were just looking at, the companies within real estate, they have to deal with declines in their income streams, which are very, very important in terms of, big real estate companies renting out their space at fixed rates, now having to finance their end of the bargain with higher interest rates essentially reduces their margins, right? And the big looming problem is what takes this Category 5 hurricane to potentially beyond is the potential for defaults, people and companies putting up the money for these investments, using their models to say, okay, we can work with this higher interest rate environment as long as we can rent out the space at X, which is higher than what we're paying in interest. But if, those projections collapse and the money that was supposed to be coming in to finance these higher interest rate purchases on the real estate side, if it all starts to fall apart, then you have defaults and real big problems that we've seen historically in the real estate market amid high interest rates. For the time being, the fundamentals around these stocks and, different companies and different individuals also on the consumer level are holding up. We're not seeing an absolute collapse in this market quite yet, and we don't have to see one. Of course, the Fed has said that they're looking for a soft landing to inflation. The reason why they're hiking interest rates higher, they want to cool the economy and cool the price of real estate and everything else without necessarily making it crash. And they have pretty successfully so far done exactly that. It doesn't have to conclude, like I say, in a whole mess of defaults, but we'll see how this whole thing shakes out. For the time being, trending lower across the board in the real estate industry. Hopefully that can settle in at a normal level without a full-on collapse in the real estate market.